Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone, partner at Strategas and head of technical and macro research for the firm. Chris, how are you doing today?
I'm doing great, Ross. Thanks for having me back.
Thrilled to have you back on, and I think we're having you on at a really important time for markets because there's this disorienting theme that you've been writing about, which is a rally in stocks and yet a very inverted yield curve. You can see this theme in all sorts of pockets of the markets, but I want to get your broader take on how this is playing out and what it might mean as we head forward into year end.
Yeah, Ross, I think it's a great question. And I think certainly the word disorienting is appropriate to describe the market here. It's been a very good rally since mid-October. But what I think is notable on the other side is what hasn't changed. And in particular, the yield curve, if anything here, has only gotten more inverted as we kind of speak this morning. Twos and tens, I think, are negative 65 basis points. So the two-year yield is trading some 65 basis points above where the 10-year yield is. So on one hand, we've had this very good equity rally, S&P up 12, 13% off the mid-October lows. It's largely been driven by cyclicals as well. We've seen industrials do better. We've seen financials do better, which is an important distinction, I think, from the rally that we saw in June and July, which was very defensively driven. So we like the improved tone out of equities. We like the improved tone out of the leadership. But I think our optimism has to be tempered by what the cycle realities of an inverted curve mean, particularly a curve that is the deepest inversion we've seen since 1981. It's really difficult to find an example where from a curve inversion of this magnitude, whether it's 6 or 12 or 18 months in the future, the economy didn't suffer a material slowdown. So I do think we have to just govern our enthusiasm about this rally given some of those cycle realities. What we did in our work this week, we went back and we looked historically. When the curve is this inverted, what are some of the largest S&P rallies that you've seen? And frankly, going back the last 75 or so years, it's rare to see a market rally much more than 15 or 20% when the curve is this inverted. So we're starting to get up into that kind of 15, 20% category off these mid-October lows. And Russ, I would add, I think the other disorienting feature of this market over the last several weeks is all of these rumors about China reopening and China reflating commodities, yet crude oil really hasn't responded to it. Crude's about to make a 1-month low here. Also, Chinese high yield bonds really have not responded to some of that optimism. So I think it's our job as analysts to always look for when the market pushes back against the consensus innuendo or the consensus rumor. And I think there's two examples of that right now.
So you very eloquently described the disorienting messages that the markets are sending. And in talking to investors and some of our clients, I get that sense as well. So to flip that, I'm curious, what is something that you do have high conviction in right now, an opinion or a call, something that you're really willing to hammer the table on?
Yeah, it's a great question. And Ross, I would go back to kind of the theme that's been so dominant in our thinking and our work really over the last 18 months. It's this idea that as investors right now, we have to, quote, be different than the index. Right? The index right now, 5 stocks comprise something like 25% of the weight. I think they are the weakest names or the weakest parts of the market. On the other side of that, and we know what those names are, they're the large tech weights, the large growth weights. On the other side of that, the average issue is actually getting better. So the way we've expressed that is owning the equally weighted S&P 500 and moving away from the top of the market, the big weights, the triple Qs, the large growth stocks. That's a theme that's been so durable in our thinking over the last 18 months. And I don't see a ton of evidence that that is really changing here. And, you know, we go back to kind of the bigger picture. What has driven this migration out of or away from the big weights and I think toward the average issue? I think it's the change in the price of money. I mean, low rates were a tailwind for tech for so much of the last decade. I think that's certainly less so the case right now. And when we think about bond yields in general, while they're 50 or 60 basis points off their recent highs, I think the fact that tech really hasn't rallied to any meaningful extent as an outperformer reflects that this is still a very, very different environment that tech is acting in. So we're using this rally to lighten tech exposure and add to the average stock. What does the average stock mean? Look at groups like industrials or materials or financials. They're not big weights in the index, but it's where the technical strength and the market strength has really been coming from here.
Yeah, absolutely. And not big weights and haven't been big weights for the better part of a decade. So I think that's a big regime change that investors, might need to take some time to get used to. But as you note, certainly seems like a sticky theme. Chris, I want to thank you so much for your time. This is always super insightful, and we'll hope to have you again on soon before the end of the year.
Thanks, Russ.